In this lecture, we are moving beyond 100% acquisitions to explore one of the more complex and interesting areas of advanced accounting: how to account for a subsidiary when you don't own all of it. We'll be looking at the concepts of non-controlling interests and the strategic role of control premiums. We often think of acquisitions as all or nothing deals. But in the real world, many of the largest companies, like Walmart, control their subsidiaries without owning every single share. So why would a company do this? There are several strategic reasons. Sometimes it's simply too expensive to buy every last share. In other cases, especially in foreign markets, keeping some local ownership can be great for business relationships. And sometimes, a few shareholders simply refuse to sell. This situation, where a parent has control but owns less than 100%, creates what we call a non-controlling interest, or NCI. This leads to a core accounting principle known as the economic unit concept. The rule is simple but powerful. Even if a parent owns less than 100%, say 90%, as long as it has control, it must consolidate 100% of the subsidiary's assets and liabilities. GAAP views the parent and its subsidiary as a single economic entity. The portion we don't own, that 10% non-controlling interest, is then carved out and shown as a special slice of equity on the final consolidated balance sheet. This brings us to one of the most interesting parts of M&A valuation, the control premium. Ask yourself this question: is the price for one share of a company the same as the price for the share that gives you the power to run the entire company? The answer is almost always no. An acquirer typically pays a control premium, an extra amount above the current stock price, to gain that crucial controlling interest. And here's the key rule: this premium is only paid for the controlling shares. The remaining non-controlling interest shares are still valued at their standalone market price. Let's walk through an example. In our first, simpler scenario, we'll assume no control premium was paid. Portage Inc. acquires 90% of Stone Inc. for $630,000. The remaining 10% non-controlling interest is valued at its market price of $70,000. As you can see in the first line, this gives us a total firm value of $700,000. Next, we subtract the fair value of the assets we can actually identify, which in this case is given as $600,000. The leftover amount, the difference between what we paid and the value of the net assets, is $100,000. This is our goodwill. Now, how do we allocate that $100,000 of goodwill? When no control premium is paid, the allocation is simple and proportional. As you can see in the table, we compare the value of each party's interest to their share of the net assets. Portage gets 90% of the goodwill, which is $90,000, and the non-controlling interest is allocated its 10% share, which is $10,000. Now let's see what happens when things get more interesting and a premium is involved. In our second scenario, let's assume Portage paid a $45,000 control premium to acquire its 90% stake. Their total cost is now $675,000. Notice that the value of the non-controlling interest does not change. It's still valued at its standalone market price of $70,000. This increases the total implied value of the firm to $745,000. When we subtract the same $600,000 of net assets, our total goodwill rises to $145,000. But who does this extra $45,000 of goodwill belong to? This is the critical takeaway. Since the control premium was paid by the parent, the extra goodwill that it creates is allocated entirely to the parent. Look closely at the table. The non-controlling interest share of goodwill is still the same $10,000 as before, because they didn't pay the premium. Portage's allocated goodwill, however, is now $135,000, their original $90,000 plus the full $45,000 premium. This disproportional allocation is a key concept for both reporting and future impairment testing.